So, good day, sir. So, our topic is all about the exporting and importing counter trade. Exporting involves a company or individuals selling goods or services produced in their home country to customer located in other country. Importing is an act of purchasing goods or services from a foreign country and bringing them into one's own country. And the counter trade is a system of trading where goods or services are exchanged without using cash or conventional payment methods. So the introduction is the volume of export activity in the world economy is increasing as exporting has become easier. Firms are increasingly using the internet toll-free 800 phone numbers and international air express service to reduce the cost of exporting. Exporting remains a challenge for many firms. Smaller enterprises can find the process intimidating. The firms wishing to export identifying foreign market opportunities. The promise of pitfalls exporting. The great promise of exporting is the large revenue and profit opportunities are to be found in foreign market. For most firms in the most industry, the international market is normally so much larger than the firm's domestic market that exporting is nearly always a way to increase the revenue and profit base of a company. Common pitfalls include the poor market analysis, poor understanding of competitive condition in the foreign markets, a failure to customize offering the needs and of foreign customers, lack of effective distribution program. Improving export performance. Inexperienced exporters have a number of ways to gain information about foreign market opportunities and avoid common pitfalls that tend to discourage and frustrate exporters. So, to improve the export performance, businesses and government they should focus on market expansions, diversification, and proactive strategies. So next is an international comparison. One big independent to exporting is the simple lack of knowledge of opportunities available. There are many ways market for a firm's product, but because they are encounter separated from the firm's home base by culture, language, distance, and time. The way to overcome the ignorance is to collect information. In Germany, one of the world's most successful exporting nations, trade association, government agencies, and commercial banks and gathered information. So, an international comparison is all about to understand global trends, inform policies decision, and aid businesses in understanding international markets. So next is FCX system. FCX system is an American exporting success story. FCX makes power converters for the aerospace industry. The device convert common electric utility frequencies into higher frequency. FCX initially got into exporting because it found that the foreigners were often more receptive to the company's product than the potential American customers. In 1989, FCX signed on in, with an international distribution company to help with exporting. In 1994, FCX started to handle the exporting company's process on its own. The Department of Commerce and Development Office of West Virginia. These agencies demystified the process of exporting and provided FCX with good products. So next is all about information sources. Despite institutional disadvantage, U.S. firms can increasingly awareness of export opportunities The most comprehensive sources of information is the U.S. Department of Commerce. Its district offices all over the country. Within the department are two organizations dedicated to providing business with intelligent assistance for tracking foreign markets, International Trade Administration, and the United States and Foreign Commercial Services Agency. The Department of Commerce also organizes trade events that potential exporters makes foreign contacts and explore with opportunities. The department also has a marketers programs. The department representative accompany group of U.S. business abroad to meet with qualified agent and distributors for customers. So next is all about information sources. Despite institutional disadvantage, U.S. firms can increasingly awareness of export opportunities. The most comprehensive sources of information is the U.S. Department of Commerce. Its district offices all over the country. Within the department are two organizations dedicated to providing business with intelligent assistance for tracking foreign markets, International Trade Administration, and the United States and Foreign Commercial Services Agency. The Department of Commerce also organizes trade events that potential exporters makes foreign contacts and explore with opportunities. The department also has a marketers programs. The department representative accompany group of U.S. business abroad to meet with qualified agent and distributors for customers. So next is all about the utilizing export management companies. Export management companies are export specialists who act as the export marketing department or international department for their clients' firms. They start exporting operation for a firm with the understanding that the firm of takeover operation after they will establish. The advantage of export management companies is that they experience specialists who can help new type export exporter identify opportunities and avoid common pitfalls. So the export management companies is all about the valuable strategies for a business, particularly to new international trade or to seeking to expand their reach without significant investment in our house export expertise. So next is all about export strategies at 3M. The Minnesota Mining and Manufacturing Co. 3M makes more than 40,000 products including tape and medical products. In 2006, the firm generated in 61% its $23 billion in revenues outside the United States. 3M's remains a major exporter with over $2 billion export. The company often used to establish an initial presence in the foreign market. 3M export strategy is built around simple principles or as FIDO. The essence of FIDO is to gain a edge over other exporters by getting into a market first and learning about the country. The the 3M is all about the Minnesota mining and manufacturing. Yeah. So next is all about the red spot point and varnish. Established in 1902 in Evansville, In Generates, Pan Point, and Varnish, company is in many ways the typically of a company that can be found in the small towns in America's heartland. So the red spot products are the Sen automobile bumpers, wheel covers, grill and heart lights, instrument panels, door, insert, radio buttons, and other components. The red spot has along had some international sales and once won an export award to further its international businesses. Red Spot hired a Central Michigan University professor, Brian Williams, who was hired because of his foreign language skills. So according to Williams daw is ang red spot is needed people who understand the nuts and bolts and exporting and letters of credit payment terms and bills of lading and so on point of varnish. So next is all about the red spot point and varnish. Established in 1902 in Evansville, Indiana, red spot point and varnish company is in many ways the typically of a company that can be found in the small towns in America's heartland. So the red spot products are the Sen automobile bumpers, wheel covers, grill and heart lights, instrument panels, door, insert, radio buttons, and other components. The red spot has along had some international sales and once won an export award to further its international businesses. Red Spot hired a Central Michigan University professor, Brian Williams, who was hired because of his foreign language skills. So according to Williams daw is ang red spot is needed people who understand the nuts and bolts and exporting and letters of credit payment terms and bills of lading and so on point of varnish. So next is all about the lack of trust. Firms engaged in international trades have to trust someone they may have never seen or who lives in a different countries, who speaks a different language. This lack of trust is exacerbated by the distance between the two parties in space, language, and culture, and by the problem of using the understand develop international legal system informs to contractual obligation.
Good day, sir. The next topic is letter of credit. So, a letter of credit, abbreviated as LC, stands at the center of international commercial transaction issued by a bank. Of the request of an importer, the letter of credit states that the bank will pay a specified sum of money to a beneficiary, normally the exporter, on presentation of particular specified documents. For example, having seen the letter of credit, the Bank of New York might be willing to lend the exporter funds to process and prepare the merchandise for shipping to France. So this loan may not have to be repaid until the exporter has received his payment of the merchandise. As for the French importer, she does not have to pay for the merchandise until the documents have arrived, and unless all conditions stated in the letter of credit have been satisfied. So the drawback for the importer is the fee. So she must pay the Bank of Paris for the letter of credit. In addition, since the letter of credit is financial liability against her, maybe reduce her ability to borrow funds for other purposes. Draft. A draft, sometimes referred to as a bill of exchange, is the instrument normally used in international commerce to effect payment. So, in the example of draft is um, U.S. exporter and the French importer. So, the exporter writes a draft that instructs the Bank of Paris, the French importer's agent, to pay for the merchandise shipped to France. So the person or business initiating the draft is known as the maker. In this case, the US importer, the party to whom the draft is presented, is known as the draw, in this case the Bank of Paris. So a draft is and the definition of draft is, or the explanation of draft is simply an order written by an exporter in instructing an importer of or an importer's agent to pay a specified amount of money at a specified time. The the two categories, site drafts and time drafts. So a site draft is payable on the presentation to the draw, and a time draft allows for a delay in payment. So the time draft becomes a promise to pay by the accepting party. When a bank accepts and draw on the time draft, it is called a banker acceptance. So when a business firm accepts and draws on it, it is called a trade acceptance. So time drafts are negotiable instruments, that is, once a draft is stamped with an acceptance, the maker can sell the draft to an investor at a discount from its face value. So the bill of lading, the third key document for financing international trade, is the bill of lading. So the common carrier is transporting the merchandise issues the bill of lading to the exporter. It serves three purposes. So it is a receipt, a contract, and a document of title. So as a receipt, the bill of lading indicates that the carrier has received the merchandise described on the face of the document. So as a contract, it specifies that the carrier is obligated to provide a transportation service in return for a certain charge. So as a document of title, it can be used to obtain payment or a written promise of payment before the merchandise is released to the importer. So the bill of lading can also function as collateral against which funds may be advanced to the exporter by its local bank before or during the shipment, and before final payments by the importer. So the example of the bill of lading, the carrier of Swift Cargo Shipping would issue a bill of lading detailing, so for example, shipper, so destination, shipping route, and terms and conditions. So Swift Cargo Shipping standards, terms and conditions related to cargo handling, liability, and dispute resolution. Here are typical international trade transactions. The typical transaction involves 14 steps. The first is the French importer places an order with the U.S. exporter and asks the American if he would be willing to ship under a letter of credit. And the second, the U.S. exporter agrees to ship under a letter of credit and specifies relevant information such as prices and delivery terms. The third is the French importer applies to the Bank of Paris for a letter of credit to be issued in favor of the U.S. exporter for the merchandise the importer wishes to buy. Fourth, the Bank of Paris issues letter of credit in the French importer's favor and sends it to the U.S. exporter's bank, the Bank of New York. Fifth, the Bank of New York advises the exporter of the opening of a letter of credit in his favor. Sixth, the U.S. exporter ships the goods to the French importer on a common carrier, and official of the carrier gives the exporter a bill of lading. 7. The U.S. exporter presents a 90-day time draft drawn on the Bank of Paris in accordance with its letter of credit and the bill of lading to the Bank of the New York. The exporter endorses the bill of lading, so title to the goods is transferred to the Bank of New York. 8. The Bank of New York sends the draft bill of lading to the Bank of Paris. The Bank of Paris accepts the draft, taking possession of the documents and promising to pay the now accepted draft in 90 days. 9th, the Bank of Paris returns the accepted draft to the Bank of New York. 10th, the Bank of New York tells the U.S. exporter that it has received the accepted bank draft, which is payable in 90 days. 11. The exporter sells the draft to the Bank of New York at a discount from its face value and receives the discounted cash value of draft in return. 12. The Bank of Paris notifies the French importer of the arrival of the documents. She agrees to pay the Bank of Paris in 90 days. The Bank of Paris releases the documents so the importer can take possession of the shipment. 13. In 90 days, the Bank of Paris receives the importer's payment, so it has funds to pay the maturing draft. The last one is in 13 days, the holder of the matured acceptance. So in this case, the Bank of New York presents it to the Bank of Paris for payment. The Bank of Paris pays. Export assistance. Prospective U.S. exporters can draw on two forms of government-backed assistance to help finance their export programs. They can get financing aid from the Export-Import Bank and Export Credit Insurance from the Foreign Credit Insurance Association. So, export assistance examples include government provide resources such as export credit agencies like the U.S. Export-Import Bank or trade missions that help businesses connect with potential buyers abroad. So, for example, government support export credit agencies. So, these agencies like U.S. Export-Import Bank provide financing and insurance for exports, helping businesses mitigate risks associated with international trade. Government-sponsored trade missions bring businesses to foreign markets, facilitating network markets, research, and sales. So these agencies, like the U.S. Small Businesses Administration, so the initial of SBA, the UK Department of Trade and Investment provide guidance, training, and recommendation to help business navigate the export process. And the second example is business matching. So this service offered by some government agencies provides matchmaking appointments with potential partners in foreign markets. So for example, market research. So government agencies often provide market research and information on potential export markets, helping businesses assess their suitability. And the financing and insurance. So export credit insurance. So this um, insurance protects businesses from losses due to non-payment by foreign buyers. Export-Import Bank. So the Export-Import Bank, often referred to as EXIM Bank, is an independent agency of the U.S. government. Its mission is to provide financing aid that will facilitate exports, imports, and the exchange of commodities between the United States and the other countries. EXIM Bank pursues this mission with various loan and the loan of guarantee programs, and the agency guarantees repayment of medium and long-term loans. U.S. commercial banks make to foreign borrowers for purchasing U.S. exports. The exempt bank's guarantee makes the commercial banks more willing to lend cash for foreign enterprises. Here are some examples of Export-Import Bank of the United States. So a federal agency that provides loans, guarantees, and insurance to support U.S. companies in international sales, as well as supporting U.S. product importers by providing credit to foreign buyers. So these banks play a crucial role in supporting international trade by providing financial assistance to exports and importers, helping them navigate the complexities of international transactions and market. Export credit insurance. So, for our reasons outlined earlier, exporters clearly prefer to get letters of credit from importers. However, sometimes an exporter who insists on a letter of credit will lose an order to one who does not require a letter of credit. So, thus when the importer is in a strong bargaining position and able to play competing suppliers against each other, an exporter may have to forego a letter of credit. The lack of letter of credit exposes the exporter. Export credit insurance can conveniently be classified as either short-term or long-term. So, for example, short-term export credit insurance might offer 90 to 95% coverage against a buyer's payment default and would generally cover sales of such items as consumer goods, materials, and services up to 180 days, and small capital goods, consumer durables, and bulk commodities up to 360 days. By contrast, medium-term export credit insurance would typically provide somewhat less protection, but for a longer period of time. For instance, 85% coverage of net contract value on sales of large capital equipment for up to 5 years. So naturally, securing export credit insurance would require the payment of premiums. And the insurance premiums are based on individual risk factors such as buyer's credit worthiness as assessed by the entity that provides the insurance coverage. So the countries involved in the transaction, depending on circumstances such as insurance, can often be purchased either on a single buyer basis or on a portfolio multi-buyer basis. Again, depending on circumstances, most multi-buyer policies could be expected to cost less than 1% of the value of sales transaction being insured, while the cost of single-buyer policies varies widely. Export credit insurance is offered by private insurers and by government agencies, often referred to as export credit agencies. Counter-trade. Counter-trade is an alternative means of structuring an international sale when conventional means of payment are difficult, costly, or non-existent. We first encountered um, counter trade in Chapter 10 in our discussion of currency convertibility. A government may restrict the convertibility of its currency to preserve its foreign exchange reserves to use to service international debt commitments and purchase crucial imports. Here the explanation of counter trade. So denotes as a whole range of barter-like agreements. Its principle is to trade goods and services for other goods and services when they cannot be traded for money. Some examples of counter trade are including of following situations. There is an example of the counter trade. The Venezuelan government negotiated a contract with Caterpillar under which Venezuela would trade 350,000 tons of iron ore for Caterpillar earth-moving equipment. And the last example of this counter trade is Philip Morris shipped cigarettes to Russia, for which it receives chemicals that can be used to make fertilizer. Philip Morris ships the chemicals to China, and return China chips westward to North America for retail sale by Philip Morris. The incidence of counter trade. In the modern era, counter trade arose in the 1960s as a way of the Soviet Union and the communist states of Eastern Europe, whose currencies were generally non-convertible, to purchase imports. During the 1980s, the technique grew in popularity among many developing nations that lack the foreign exchange reserve required to purchase necessary imports. So today, reflecting their own shortages of foreign exchange reserves, some successor states to the former Soviet Union and the Eastern European communist nations periodically engage in counter trade to purchase their imports. So given the counter trade is a means of financing international trade, albeit a relatively minor one, prospective experts may have to engage in this technique from time to time to gain access to certain international markets. So the governments of developing the nation sometimes insist on a certain amount of counter trade. Types of counter trade. First is barter. Barter is the direct exchange of goods and or services between two parties without a cash transaction. Although barter is the simplest arrangement, it is not common. Its problems are twofold. First, if goods are not exchanged simultaneously, one part ends up financing the other for a period. Second, firms engage in barter run the risk of having to accept goods they do not want, cannot use, or have difficulty reselling at reasonable price. So for these reasons, barter is viewed as the most restrictive counter trade arrangement. It is a primarily used for one-time only deals and transactions with trading partners who are not creditworthy as a trustworthy. And for example, a country might trade its agricultural products for machinery from another country. Counter purchase. Counter purchase is a reciprocal buying agreement. It occurs when a firm agrees to purchase a certain amount of material back from a country to which a sale is made. Suppose a U.S. firm sells some product to China. China pays the U.S. firm in dollars, but in exchange, the U.S. firm agrees to spend some of its proceeds from the sale of on textile produced by China. So thus all the must draw on its foreign exchange reserves to pay the U.S. firm it knows it will receive some of those dollars back because of counter-purchase agreement. In a counter-purchase arrangement, the seller receives cash for their exports but is contractually bound to make a future purchase of goods or services from the buyer's country, typical a percentage of the total export value. And for examples, a company selling machinery to a foreign country might agree to purchase local agricultural products as part of the deal. Or a country might require foreign investors to invest in local industries in return for allowing them to import certain goods. Offset. An offset is similar to a counter-purchase insofar as one party agrees to purchase goods and services with a specified percentage of the proceeds from the original sale. So an offset is a type of counter-trade agreement where the supplier promises to do something beyond the initial sale to benefit the buyer. So the governments may require offsets as a condition for approving large export sales, ensuring that the import transaction brings long-term economic benefits to the importing country rather than just a time payment. Examples of offsets, for example, is offsets activities, industrial cooperation, participation. The supplier might agree to co-produce goods in the buyer's country or establish manufacturing facilities there. Investments. The supplier might invest in the buyer's country to create jobs or boost infrastructure. Switch trading. The term switch trading refers to the use of a specialized third-party trading house in a counter-trade arrangement. When a firm enters a counter-purchase or offset agreement with the country, it often ends up with what are called counter-purchase credits, which can be used to purchase goods from that country. Switch trading occurs when a third-party trading house buys the firm's counter-purchase credits and sells them to another firm that can better use them. So, for example, a U.S. firm concludes a counter-purchase agreement with Poland for which it receives some number of counter-purchase credits for purchasing Polish goods. The U.S. firm does not want any Polish goods for purchasing. It sells the credits to a third-party trading house at discount. The trading house finds a firm that can use the credit and sells them at a profit. Compensation or buybacks. So a buyback occurs when a firm builds a plant in a country or supplies technology, equipment, training, or other services to the country and agrees to take certain percentage of the plant's output as a partial payment for the contract. When both compensation and buybacks are types of arrangement where goods or services are exchanged without cash payment, a buyback is when the exporter builds a facility in a country and agrees to take a portion of plant's output as a payment, while a compensation arrangement involves taking goods as a partial payment and transferring the purchasing commitment to a third party. For example, Occidental Petroleum negotiated a deal with Russia under which Occidental would build several ammonia plants in Russia as partial payment, receive ammonia over a 20 years period. The pros and the cons of counter trade. Counter trade's main attraction is that it can give a firm a way to finance export deal when other means are not available. Given the problems that many developing nations have in raising the foreign exchange necessary to pay for imports, counter trade may be the only option available when doing business in these countries. Even when counter trade is not the only option for structuring an export transaction, many countries prefer counter trade to cash deals. So, thus, if a firm is unwilling to enter a counter trade agreement, it may be lost an export opportunity to a competitor that is willing to make a counter trade agreement. And the cons of counter trade is complexity and negotiations. Counter trade deals are often complex, require incentive negotiations which can be time consuming and costly. So the pros of counter trade is potential for lower profits. So additional costs as complexities of counter trade can ultimately reduce profits compared to traditional trade method.